Energy, the best performing sector this week, and our next guest sees big opportunity in the oil patch. Let's bring in Warren Pies of 3Fourteen Research. Warren, it's great to have you. 6 weeks up on WTI, and we're awfully close to 83 today. What do you see coming?
Yeah, thanks for having me, Carl. We have an oil model that basically looks at the crude oil market from a number of different perspectives, and that model flipped bullish early July, and it makes sense to me as a longtime oil watcher. I think that we came into this year and everybody had set themselves up for the recession trade, and this includes oil speculators. So we saw hedge funds and other speculators in the oil market had layered on short positions and basically set themselves up for this recession trade that hasn't come to pass. Well, now we're in this window where the Saudis and the rest of OPEC has finally gotten their act together and are withholding supply. And I think their goal is to basically run these shorts out of the market. And by the time this saga is over, I think we end up touching $100 a barrel on oil. And ultimately, this is going to be a big driver for the energy sector in the near term.
Wow. We did get a lot of inputs today. OPEC, Oxy, Conoco, and I think it was Pioneer that said 80 to 100 going into year end. Sounds like you agree.
Yeah, I mean, I would never listen to an upstream CEO on their projection for oil. I'd much rather listen to the downstream guys because they're the actual buyers. But in this case, I do agree. I do agree with Sheffield in this case. Yeah, I think we get triple-digit oil this year.
As for the markets, it doesn't sound like you have strong feelings either way on equities at large, although you're not averse to the idea that some of these mega cap tech results could give us a short-term pop.
Yeah, I mean, one of the things we say at 3Fourteen Research is that we build conviction on fundamentals, but we manage risk on price. And to be honest, the market is quite overvalued here. And so it's hard for me to create a real strong conviction in this market. If you think about this as a market bottom and what we're projecting for earnings, even with the earnings projections that the analysts have for 2024, it's a really subpar rebound in earnings off of what would be an equity bottom. So fundamentally, I'm not a big fan, but we have to acknowledge the price action. I do think there's a huge chase going on right now, and Jeff DeGraff just mentioned that. I think there's a rotation, and now all the laggards, everyone that came in this year expecting a recession, they're now buying different pockets of the market trying to catch up. And so I think that's the game. I think that's most likely outcome for us for the next few months until we get some kind of softening in the economic data or something in the rates market that scares the bulls off. But you really have to be careful about where you play those lagging areas. Like you could play small caps, you could play energy, you could go other pockets. And I think it's really important that we don't get over our skis with risk at this point in the cycle.
All right. Speaking of rates scaring people off, I think bonds are your biggest underweight since early June. A lot of discussion this week about the sell-off and whether or not that was due to Fitch or the idea of more issuance. You got clean thoughts on that?
Yeah, absolutely. Bonds are, to me, the only path to a positive return for bonds from here is a recession. So we don't see a recession imminent, and that was reflected in the jobs report today. And so to me, bonds are overvalued probably by about 80. We're talking about the 10-year, probably by about 80 basis points. You can look at that versus nominal GDP, overvalued. Look at it on a term premium basis, overvalued. If you think the Fed has paused here, which I think it's most likely the Fed has paused, usually the 10-year is significantly above the Fed funds rate, and now we're significantly below the Fed's fund rate at this pause. So I don't think there's a lot of upside for bonds. And then you look at what the Treasury has. I think the real impetus for the sell-off is tons of issuance, $1 trillion of issuance estimated for Q3. Who's going to buy that? The Fed's not buying it. Banks are definitely not in a position to buy it. Foreigners have been stepping away from the bond market. So ultimately, you're talking about levered hedge funds and households that have to do that buying, and those are price-sensitive buyers. So they need higher yields. That's where I think we're going.